Welcome back to the deep dive. Today, we've got something really specific on the table. We're digging into the 2016 Shareholders Letter from JPMorgan Chase's chairman and CEO. Now, this isn't just your average annual report.
No, definitely not. It's a blueprint, really, from one of the world's biggest banks. They lay out how they did, sure, but also their whole take on the global economy, policy, you name it.
Exactly. So for you listening, think of this deep dive as, well, a shortcut. It's a way to get inside the thinking of high finance, see how they grade themselves, and maybe more importantly, where they think things are going wrong outside their walls.
Right. We've got a whole stack of material here, the letter, related docs. We're aiming straight for the core strategic thinking.
Okay, so let's kick off with the raw numbers. The scorecard, if you will. Because, honestly, everything else kind of builds on this. 2016, they called it another breakthrough year. Pulled in a record $24.7 billion in net income. That's on nearly $100 billion in managed revenue.
Huge numbers.
And look at the stock performance, right? Since 2000, they clocked an 11.5% compounded annual gain.
Yeah, compare that to the S&P 500. Just 4.3%.
It really screams dominance, doesn't it?
It does. And they absolutely use that performance as the launch pad for the first big section in the letter.
Yeah.
It's all about how they measure their own success. They actually push back a bit on traditional metrics, like just book value.
Oh, so what do they prefer?
They pivot to tangible book value, TBV.
Okay, hold on. Tangible book value. Why that specific metric? It sounds pretty technical.
It is, but it's important for their argument. See, TBV basically strips out the intangible stuff. Think goodwill from old mergers, things that aren't, hard assets generating cash right now.
Okay, so it's more focused on the stuff that actually earns money.
Exactly. By focusing on TBV, they're saying, look at the real capital we have, the tangible stuff. And if they can make, say, a 15% return on that tangible equity, they argue the company's inherently worth a lot more than just that base TBV. It's an efficiency play.
Gotcha. And I guess that efficiency logic underpins their capital return strategy. They mentioned spending a lot on buybacks.
A lot. $25.7 billion over 5 years, they point out. And the CEO actually defends buying back stock, even when the price is around, say, 2 times TBV.
Really? How do they justify that?
They argue it's still a good use of capital, expected to boost earnings per share by maybe 3 or 4% over the next 5 years.
So it's presented as a smart, value-adding move.
Yeah, risk-managed, value additive. But, the real muscle behind that argument, it comes from their individual businesses.
Yeah.
The franchise strength. They spend a lot of time showing that each major division, consumer banking, the investment bank, commercial, asset management, they're all top-tier performers.
And how do they prove that? What's the evidence?
Efficiency ratios are key. They boast about their overall overhead ratio being 56%.
Which compares pretty well to others, right?
Yeah, they specifically call out Wells Fargo at 59% and Bank of America at 65%. In that post-crisis world, being lean is, it's a survival skill.
And a competitive weapon.
Absolutely. And it's not just efficiency. They show they're actually grabbing market share, too. Like consumer deposit share went up noticeably. And the investment bank, #1 globally in fees and fixed income trading share.
Okay, so the message is clear. We're performing well, we're efficient, we're growing. That's the foundation.
Precisely. Performance validates the strategy.
So once they've established that strength, that fortress balance sheet, as they like to call it, where do they turn their attention? What's the next focus?
Right. That brings us neatly into the second section. It's really about the future, the offense. Where's the money going?
And a big chunk seems to be going into tech.
Oh, absolutely. The number is kind of mind-blowing. $9.5 billion.
$9.5 billion in 1 year on technology.
Yep. Firm-wide in 2016. And get this, $3 billion of that was specifically for new initiatives, including $600 million just for dipping into emerging fintech solutions.
Wow. Okay, that's not just keeping the lights on. That's a serious bet on technology driving future growth, maybe even more than traditional banking.
Totally. And you see the output, right? They talk about building end-to-end digital banking.
Meaning?
Like opening an account, doing all your transactions, everything just on your phone. Plus, rolling out online investment advice, self-directed platforms.
So bringing banking fully into the digital age.
But what's also interesting is they're not trying to do it all alone. They admit they can't.
So partnerships.
Yeah, they highlight collaborations. Some names you'd know, like Zelle for payments, but also others like Roostify for mortgages, OnDeck for small business loans. It's a mix. Build, buy, partner.
Okay, and while they're building all this tech, there's the data issue. protecting customer information. That comes up too, right?
Big time. They addressed that head on. For a long time, the way apps got your bank data was, well, you gave them your password.
Which sounds incredibly risky.
It was. Huge security risk, plus potential liability for the customer if something went wrong.
So how do they fix that?
They talk about a new standard they set up, specifically with Intuit, the QuickBooks people. Instead of sharing passwords, the customer gets control. They can actively push only the specific data they choose to share.
Ah, so you control the data flow, turn it on, turn it off?
Exactly. It flips the model, gives the customer power, and crucially gets rid of that liability risk from just handing over your keys, so to speak.
That makes sense. Protecting the core data,
Yeah.
the customer, that actually feels like a good bridge to the external risks they were watching. Let's shift gears a bit. Section 3, risk, regulation, and this idea of the cost of complexity.
Yeah, they definitely had their eyes on the horizon. Geopolitical risks were high on the list back in 2016.
Like what specifically?
Well, number one was Brexit. They were actively planning for a hard exit scenario,
What does that mean in practice?
building up or expanding subsidiaries inside the EU, moving technology, even moving some people. Basically making sure essential stuff like, underwriting deals or moving money could continue without a hitch, no matter what the politicians decided.
Okay, contingency planning. What else?
The other big one was this rising tide of, anti-trade sentiment, deglobalization fears, particularly rhetoric aimed at places like Mexico and China.
And they have interests there.
Significant interest. The letter points out, I think, around $400 million in revenue from Mexico, $700 million from China. So the CEO basically warns against poorly conceived anti-trade policies. It's a nudge saying, hey, this could hurt global business.
Understood. But the real fireworks in this section seem to be around regulation, especially the aftermath of the financial crisis.
Oh, absolutely. This is where they go on the offensive. The core message, stated very clearly, is too big to fail has been solved. Full stop.
That's a bold claim. How do they back it up?
They list the changes. Way higher capital levels, much more liquidity, new rules like bail endowable debt.
Explain that one quickly.
Sure. It basically means if the bank gets into deep trouble, certain types of debt automatically convert into equity, into ownership shares. So the debt holders take a hit, absorbing losses before taxpayers ever would. Plus, regulators just have stronger legal tools now to step in.
So the argument is the system is fundamentally safer. Taxpayers are protected.
Emphatically, yes. They stress that losses hit shareholders and those debt holders first through things like TLAC, total loss absorbing capacity. And even if that weren't enough, the industry itself is on the hook legally for any leftover losses. They mentioned JPM alone paid almost $12 billion into the FDIC fund since '07.
Okay, so if they believe the system is safe, where does the critique come in?
Right, that's the pivot. Because the system is safe, they argue, banks now actually have too much capital tied up.
Too much capital. How do they argue that?
They point directly at the CCR stress tests,
Yeah.
the Fed's really severe what-if scenarios. Well, they say, look at the results. Even in that extreme doomsday scenario, the combined losses projected for, 33 major banks, it was less than 10% of their total capital.
Ah, so they're saying the buffer is way bigger than even the worst-case scenario requires.
Exactly. They see that as proof positive of excess capacity just sitting there, unused, because of flawed rules.
Which rules specifically?
They target a couple technical ones. The GSIB surcharge, that's the extra capital penalty for being a global systemically important bank. And the SLR, the supplementary leverage ratio.
And the problem with these rules, in their view,
is that they penalize things that should be basically risk-free,
Hmm.
like a bank just holding customer deposits as cash at the Federal Reserve. That actually increases their capital requirement under some of these rules.
seems counterintuitive.
They think so. And they argue that the U.S. went too far, gold-plating international standards.
Gold plating, meaning going above and beyond what was required globally.
Right. And this isn't just theoretical complaining. They put a number on it. They estimate that just removing that gold plating on the GSIB surcharge, that alone would free up $15 billion in equity capital.
$15 billion. And what could that capital do if it wasn't tied up?
That's the kicker. It could support almost $190 billion in new loans to the economy.
Wow. Okay, so the argument is complex, overly conservative rules aren't just technicalities. They're actively holding back lending and economic growth.
That's precisely the connection they make.
Which seems like the perfect lead-in to Section 4, where they broaden out from just bank rules to look at the whole U.S. economy. There's a real sense of concern there, isn't there?
Deep concern. The CEO expresses real frustration with the pace of U.S. growth.
How do they frame that?
They use some pretty stark historical data, like real GDP per person grew about 2.3% a year from, say, 1948 to 2000.
Okay, a healthy clip.
Yeah, but from 2000 to 2016, it dropped to just 1%.
Big slowdown.
Huge. And they calculate that if growth had just kept that older pace, the average American's income, GDP per capita, would be 24% higher.
24%.
Yeah.
That's over $12,500 per person.
Right. It's a massive difference.
Yeah.
They basically see it as a long-term policy failure.
And do they pinpoint specific reasons for this slowdown? What are the culprits?
They list several things they call self-inflicted problems.
Such as?
First, labor markets. They focus on prime-age men, 25 to 54. Their participation in the workforce dropped from 96% back in the late 60s to just over 88%.
And how does that compare internationally?
Significantly lower than the average for other developed countries, the OECD average. That's a drag on potential growth right there.
Okay, what else?
Taxes. No surprise, they criticized the U.S. corporate tax rate, saying it was the highest among developed nations at the time.
Driving investment overseas.
That's the argument. And interestingly, they cite analysis suggesting that the burden of high corporate taxes doesn't just fall on companies. It actually hits workers hardest, depressing wages. They say labor bears over 70% of it.
Okay, labor, taxes. What's next?
Infrastructure.
Yeah.
Can't have a modern economy without it. They point to the U.S. ranking, like 27th globally on basic infrastructure requirements. And the American Society of Civil Engineers gave the U.S. a D-plus grade.
D-plus, and not exactly confidence-inspiring.
No. Crumbling roads, bridges, grids.
Huh?
It's like a hidden tax, slows everything down.
And then, inevitably, they come back to regulation.
Yep. Excessive regulation.
Yeah.
They gesture towards the sheer volume, the thousands of pages in the Code of Federal Regulations, and they cite some, frankly, staggering estimates of the annual cost, maybe up to $2 trillion spent dealing with regulations.
And they link that cost to fewer new businesses.
Yeah, they note that despite the population growing significantly, the number of new companies being formed each year actually declined slightly between 1980 and 2013. Less dynamism.
Okay, so complexity costs less dynamism, and they have a prime example of where this really bites, right? The mortgage market.
Oh, yeah. This is where the critique gets really specific and, you could argue, quite powerful. They describe the post-crisis mortgage landscape. 7 different federal regulators, overlapping rules, something like 14,000 pages of new regulations.
14,000 pages, just for mortgages.
Apparently.
Yeah.
Creating what they called a highly risky and unpredictable operating environment.
And the result of all that risk and unpredictability.
Well, the tragic irony, they argue, is that it hurt the very people the rules were meant to help. Banks tightened the credit box way up. Average FICO scores for getting a mortgage shot up.
Making it harder for first-time buyers or people with less than perfect credit.
Exactly. Less access to loans, especially for lower and moderate income families.
Wow. So good intentions leading to negative consequences due to complexity.
That's the narrative. And they quantify the impact. Their analysis suggested all this friction probably cut mortgage lending by over $300 billion a year.
$300 billion a year.
Which, over 5 years, they estimate could have cost the economy about 0.5% of GDP growth annually.
So it's not just an inconvenience. It's a measurable economic drag directly hitting opportunities for homeownership.
That's the argument, loud and clear. Regulatory complexity has real negative consequences for ordinary people.
Which actually leads quite naturally into the final section, Section 5. After all this critique of policy and lost opportunity, they pivot to what they are doing, corporate citizenship.
Right. It's like saying, okay, this system has problems, but here's how we're trying to make a difference. The moral side of the balance sheet, as you put it.
And how do they demonstrate that? Starts with their own employees.
Yeah, they made a point of increasing minimum wages for about 18,000 workers, mostly tellers, customer service folks, raising the floor to between $12 and $16.50 an hour, depending on the local market. That's a tangible response to the wage stagnation issue they raised earlier.
Good point. What about diversity and inclusion?
They highlight their numbers. Women making up half the workforce, around 30% of senior leadership globally, including heading up major areas like finance, legal, the whole consumer bank.
And they mentioned veterans, too, I recall.
Yes, the 100,000 Jobs Mission.
Right.
An initiative they helped launch. JPM itself had hired over 11,000 veterans since 2011. So concrete actions there.
Okay, so investing in their people. What about outside the bank walls, community investment?
That's grown significantly, too. They said philanthropic giving had more than doubled over the previous decade, hitting about $250 million in 2016.
Is there a signature project they focused on?
Absolutely. The Detroit Initiative, that got a lot of attention. A $100 million commitment to help accelerate the city's recovery. Things like funding neighborhood revitalization, supporting small businesses.
Like the Entrepreneurs of Color Fund.
Exactly. That fund apparently deployed almost $3 million in its very first year. So targeted, place-based investment.
So bringing it all together, what's the final message from the letter?
It really boils down to a call for collaboration. The CEO emphasizes that this issue of lost opportunity, slow growth. It's both an economic and a moral crisis. And the only way to tackle these huge structural problems effectively is if business and government actually work together constructively.
Okay, let's try and synthesize this for the listener. What does it all mean when you step back? You've got this picture of JPM as internally incredibly strong. Fortress balance sheet, forward-looking tech investment, hyper-efficient operations. They're very confident in their own execution.
Yeah, supreme confidence internally. But then you contrast that with their external view, which is a pretty sharp critique of the broader policy environment. Too complex, they say, demanding too much capital in the wrong ways, and failing to address fundamental drags like outdated tax codes and crumbling infrastructure.
So for you, the listener, understanding this provides really important context. It shows how, at the highest levels of finance, things like regulatory efficiency and smart public policy aren't just side issues.
No, they're seen as absolutely central. Policy inefficiency is viewed almost like a major market risk, a primary constraint on growth and opportunity.
And that brings us to a final thought for you to chew on. We heard how the letter detailed the immense complexity in areas like mortgage regulation, thousands of pages, unintended consequences, making it harder for regular people to get loans, potentially costing the economy 0.5% of GDP growth a year. If that kind of complexity itself is a major barrier to economic opportunity, here's the question. What specific unwinding of unnecessary complexity needs to happen first? Forget adding new laws for a moment. What needs to be simplified or removed to make the system genuinely work better, be more accessible, more effective for the average American?
Yeah, what's the real cost of that hidden complexity we all navigate? Something to think about.
Definitely. Thanks for diving up with us today.
Our pleasure.
We'll catch you on the next deep dive.